Gold has already made its move. It hasn't happened with a lot of fanfare, and it certainly hasn't been dominating the financial headlines. Instead, it's shifted in the way it always does, quietly, when the deep foundational assumptions of our monetary system are being reevaluated. But silver? Well, silver hasn't followed. Now, to many observers, this gap looks like a sign of silver's weakness, or maybe even a failure of the whole precious metals thesis. But that's a fundamental misinterpretation. You see, silver's inaction isn't a failure. It is a feature of the sequence. It is, in fact, by design.
So, in this analysis, we're going to deconstruct the really intricate relationship between these two metals. We're going to map out the unseen sequence that governs their movements. We'll explore their fundamentally different roles in the global financial system. Then, we'll look back at history's repeating rhythm, examining past cycles of monetary stress. We'll also analyze silver's unique dual identity, the split personality it has as both an industrial and a monetary asset. And finally, we'll apply this whole framework to today, exploring why this current cycle has such unique properties and how you can observe the sequence as it unfolds, not through price prediction, but through a real systemic understanding. At the very heart of this entire framework is a concept that's simple on the surface, but truly profound in its implications. And it's this: gold and silver don't move together. They move in a deliberate, predictable, and historically consistent sequence. Gold's initial move, that's the opening act. It's a subtle but incredibly significant signal that long-term confidence in the existing financial architecture is starting to weaken. Now, this isn't about day-to-day market noise. This is about the slow erosion of trust in things like sovereign debt and fiat currency. Silver's eventual move is the confirmation of that erosion. It's the market's powerful and often violent response once that quiet weakness becomes an acknowledged, visible reality for everyone to see. This is where most market participants really misunderstand silver. They expect it to act like a direct, high-beta proxy for gold, but it has rarely, if ever, played that role in the early stages of a cycle. You see, gold acts as the system's most sensitive early warning signal. Its price reflects a very subtle, often imperceptible shift of capital away from confidence in paper assets and sovereign promises, and towards a neutral asset with zero counterparty risk. Silver, on the other hand, is the confirmation. Its price action validates the very concerns that gold first identified, but it only does so after those concerns have become concrete, tangible, and visible to the broader market. So the divergence we're all observing right now isn't an anomaly. It's the pattern revealing itself in its purest form. Now, to truly grasp this sequence, we first have to understand that gold and silver are not interchangeable assets. While they're both precious metals, their roles in the market are fundamentally distinct. And this distinction, well, it's the engine that drives their sequential behavior. One is accumulated as a function of declining trust in the system, while the other is bought in reaction to the visible stress that this declining trust eventually creates. Gold's primary function in any modern portfolio is to exist entirely outside the financial and industrial system. It's an asset that carries no counterparty risk. Its value isn't dependent on a government's promise to pay you back, or on a corporation's earnings, or even on the overall rate of economic growth. It is, for this reason, a pure store of value, a direct reflection of confidence in all other assets. Silver, however, has this conflicting dual identity. It lives both inside the system as a critical, irreplaceable industrial commodity and outside the system as a historic monetary metal. This duality is the single most important variable in understanding its price behavior. And that duality brings us to their very distinct triggers. Gold is a barometer of confidence. It moves when long-term faith in the stability of currencies and the solvency of governments starts to erode. This can happen, and it often does, while the surface of the economy and markets looks perfectly calm. Silver, conversely, is a barometer of stress. It moves when that underlying erosion of confidence finally manifests as visible, undeniable stress in the system. Things like a credit event, a currency crisis, a sharp economic downturn, or a major central bank policy shift. This is precisely why silver almost always lags gold. It's not weaker, it's simply waiting for the system to overtly confirm what gold already sensed covertly. And I want to be clear, this sequence isn't some speculative theory. It's a deeply ingrained historical pattern. It's a behavioral signature of how capital flows when it's under duress. When we examine the major periods of monetary turmoil over the last century, those moments where the very nature of money and debt was being questioned, this order of gold first, silver second, presents itself with remarkable consistency. It's just the natural, logical rhythm of how capital moves from questioning perceived safety to reacting to an acknowledged crisis. So let's move from this theoretical framework to the actual historical evidence. By examining specific episodes of macro financial stress, we can observe this sequential rhythm playing out time and time again. You'll see that these past cycles provide a clear and really invaluable map for how capital behaves and how our perceptions of assets evolve when the very foundations of the financial system are challenged.
Just consider the late 1960s. As the Bretton Woods system came under immense strain from U.S. deficit spending, gold began its steady ascent. That was the signal of deep, structural problems with the dollar's gold backing. And silver? It remained largely subdued during this period. It was only after August of 1971, when the gold window was officially closed and the crisis became an undeniable global reality, that silver's price began its historic, explosive move. We saw a similar pattern emerge in the early 2000s. After the dot-com bust and the policy response that followed, gold began a quiet, multi-year climb. Silver lagged for years, frustrating its holders. Then, in the direct aftermath of the 2008 financial crisis, silver finally made its move, compressing an entire decade of repricing into a very short, volatile window between late 2008 and 2011. The 2008 crisis actually provides a perfect miniature case study of this dynamic. During that initial liquidity panic of late 2008, while gold held its value relatively well, silver's price collapsed by approximately 57%. Now, to an uninformed observer, this looked like a catastrophic failure of its safe haven properties. But in reality, it was a necessary reset, dictated by its dual nature. The initial shock crushed its industrial component, as the market priced in a global depression. But once the monetary response from central banks began, unprecedented quantitative easing, the narrative shifted, and silver staged one of the fastest, most dramatic recoveries of any major asset class, as those monetary concerns completely overwhelmed the industrial fear. And this volatile behavior isn't random, it's structural. You have to remember, silver's market is significantly smaller and far less liquid than the gold market. This means that when significant capital flows do enter, the price impact is disproportionately large. It doesn't just ease into new price levels, it jumps to them. And this inherent sensitivity is magnified by its dual identity. The constant tension between its industrial side and its monetary side creates these long periods of quiet, followed by moments of violent repricing. So when its moment finally arrives, the adjustment is almost always explosive, not gradual. It waits, it hesitates, and then it moves with a force that shocks anyone who's unprepared. Okay, so now let's really deconstruct the core structural reason for silver's characteristic lag, this dual identity. This very attribute, which is so often seen as its greatest weakness during the early phase of a crisis, is precisely what becomes its greatest strength in the later stages. It's what provides the fuel for its eventual outperformance. In the initial stages of economic uncertainty, the market's attention is completely fixed on silver's role as an industrial input. Widespread fears of slowing growth, a potential recession, it leads analysts to forecast decreased industrial demand from manufacturing, electronics, and construction. This narrative suppresses silver's price. It causes it to underperform or even fall, while gold, which has no such industrial ties, rises on pure safe haven flows. During this phase, silver is priced by the market much more like copper than like gold. But this market perception undergoes a dramatic and often sudden shift as the cycle matures. Step one is this period of early uncertainty, where industrial fears dominate and cause all that hesitation. But as the crisis evolves from a standard cyclical slowdown into an overt monetary event marked by aggressive central bank intervention, fears of currency debasement, or sovereign debt concerns, the narrative fundamentally changes. The market's focus shifts away from silver's industrial role and moves toward its ancient monetary one. And at this inflection point, a rapid repricing event is triggered. Silver stops behaving like an industrial metal and starts to behave like leveraged gold, as a wave of monetary demand completely overwhelms any industrial demand considerations. So, while the historical sequence provides a really reliable guide for how capital flows, every cycle contains unique characteristics. The current global environment is defined by a level of systemic fragility that sets it apart from all previous episodes. And understanding these differences is absolutely critical to appreciating the potential scale of the sequence we're in right now. The most significant difference is just the sheer scale of global debt. Government debt to GDP ratios today are substantially higher than they were during the crisis of the 1970s or even at the peak of the 2008 crisis. This is the result of decades of policy choices, persistent deficit spending, the financialization of our economies,
and a long-term decline in interest rates that made borrowing seem painless. Crucially, central banks have become embedded as permanent buyers of this government debt, creating a level of artificial liquidity and leverage the world has never seen before. This elevated fragility means the potential for systemic stress is exponentially higher, and the policy tools to combat it are far more constrained.
What's truly unusual about the current cycle is that gold is rising without a widespread acknowledged inflation panic or an acute financial crisis already in motion. Historically, gold spikes in response to overt, headline-grabbing inflation or a Lehman-style event. Today, its rising is happening during a period of relative calm on the surface, and this suggests the market's concern isn't merely cyclical, it's foundational. It signals a quiet but profound concern about the long-term credibility of the currencies themselves and the solvency of the sovereign entities that issue them. It's a vote of no confidence in the system's ability to manage its own imbalances.
And this brings us back to silver's dual identity, which is more pronounced and more conflicted now than at any point in history. Unlike in past cycles, silver is no longer just an industrial metal. It has become a strategically critical input for the future. It is indispensable to the global energy transition, especially in manufacturing solar panels. It is essential for advanced electronics, 5G networks, and the entire technological infrastructure of the 21st century. This creates a powerful structural tension. Silver is absolutely vital for the world's planned future growth at the exact moment that deep-seated trust in the monetary system underpinning that growth is weakening. This tension cannot and will not resolve slowly or gradually. Now, this analysis is not about forecasting specific price targets or trying to pin down calendar dates. It's about providing a durable framework for observation. The goal here is to understand the behavior of these assets within the historical sequence so you can recognize the distinct phases of the cycle as they happen, completely independent of the daily noise of market commentary. So the central question for any observer of this market is pretty clear. How does the current, historically wide divergence between the price of gold and the price of silver eventually resolve? History is unequivocal on this point. This gap always closes. The key is not to question if it will close, but to understand the mechanism by which it does so. Silver does not gradually catch up to gold. It reprices. And a repricing event is a sudden, nonlinear adjustment that happens when the market is abruptly forced to confront a new reality it had previously ignored or dismissed. The price doesn't climb a wall of worry. It jumps a chasm of recognition. It moves violently to reflect the new state of affairs, and it often shocks market participants who are not paying close attention to the underlying structural shifts. And crucially, this dramatic repricing often happens not at the moment of peak panic, but in its aftermath. It occurs when the market's attention has shifted elsewhere, when participants have become bored or complacent with the long-standing divergence. It's in this period of relative quiet that the structural realities finally take hold. The event that triggers the shift might be small, but the repricing that follows is the culmination of years of building pressure. The final, most dramatic phase of the sequence unfolds when most people are no longer watching for it. So, to conclude, let's just return to their core, distinct functions within this macro sequence. Gold's role is to establish the initial repricing of trust. Its slow, steady climb is the market beginning to question the long-term value of paper promises and the sustainability of sovereign debt. Silver's role, then, is to later confirm the tangible consequence of that lost trust, the visible, undeniable system stress that inevitably follows. You could say that gold poses the question about systemic stability. Silver eventually provides the emphatic answer. The divergence we see today between gold and silver is not market noise, nor is it a sign of a broken thesis. It is the sound of a historical sequence playing out exactly as it has before, driven by the unchanging physics of capital flow and human psychology under duress. Understanding this rhythm is the difference between being confused by events and recognizing them as they unfold. The historical rhythm is clear. The question, therefore, is not if the sequence will complete in this cycle, but what the consequences will be for a global financial system that is more leveraged and more fragile than ever before when it finally does.